I still have a very scratchy throat, so I'll have to speak a little soft today. But with the microphone, I'm sure you can hear. Let me know if it gets too soft. Okay? All right, so last class I gave some introduction to option. It's basically an insurance, okay, to reduce or eliminate uncertainty. Okay? And it's been developed by farmers and traders. Okay? And starting from the basic, very simple concept of option, these days we have many, all kinds of, derivatives. Okay? Derivatives. Okay? So you saw some a video last class. Okay? And the derivatives can be quite profitable for investment companies and those people. You can actually make a lot of money by trading in derivatives. Okay? But you also have to understand that there is a very significant risk involved with the derivative trading. Okay. So let's get on with some details following our chapter. Okay? So there are a couple of different types of options, call option and put option. Call option gives a holder a right to purchase, right to buy at a certain price. It's called the exercise price or strike price. Yeah? So option specifies a certain price at which you can exercise the option. Okay? And then there is an expiration date. Okay? There are a couple of different types. Okay? Typically we call it American option versus European option. Okay? American option, when you have an expiration date, let's say expiration day is usually it's the third Saturday following the third Friday. Okay? What was it? This November, last week, I believe today is 27, right? 26? Today is 26, okay? So last Thursday was 19, so last Friday was 20, right? So I believe 20, 13, 6, right? Right? Friday, 6, 13, 20. So this is the third Friday of November, right? Then this Saturday, 21st, okay? This is the expiration day in America, in the United States. Okay? So typically we say SAG $40 November option. And that means this is a strike price is $40. Okay? And this is, of course, the option on GE stock. Okay? And if it's a November option, the expiration day is November 21st. That's the Saturday following the third Friday. Okay? That's how it works. Okay? And if it's an American option, you can exercise any day before the expiration day. Right? And of course, the market's closed on Saturday, so there's no way you can trade on Saturday. Right? So what that means is at the closing time on that Friday, third Friday, until that time, right? Until the closing of Friday, you have to exercise if you want to exercise. Right? That's how it works. Right? Any day on or before the expiration of Friday. Okay? European option is quite different. Okay? European option, you can exercise only on the expiration day, not before. Okay? So you have just one day, on that day, that you have to exercise it. Okay? Option premium, that's the price you pay, just like insurance premium. Okay? So in order to purchase the option, you have to pay a little bit of fee. Okay? Let me just give you a couple of examples. Okay? Who would use this option? Okay? Let's say covering. Usually, investors use option to cover, which means to limit the risk on their trade. Okay? If you are a regular investor, in other words, if you do regular investing, you purchase a stock and try to capitalize on it when the price appreciates, right? Then you will cover with the put option, covering regular trade with put option, okay? Because put option gives you right to sell your stock, okay, at a certain price. Okay? I used to write put option on GE stock, okay? Because that was in Cleveland, Ohio. There's a GE plant in Cleveland, Ohio. And there was one Korean guy, engineer at the GE plant. Okay? And he had a lot of his, I guess, basically most of his retirement fund was invested in GE stock. Okay? And GE is a very good company, very, safe investment. Okay? And he recommended this. He was doing this on the side, and he recommended that to me. Okay? When you sell put option on stock like GE, GE is a very safe stock, okay? Which means there is very little risk involved with GE investment, right? It means investment in GE stock, okay? So if the risk is small, then premium is also small, right? So you can make a lot of money on this exercise, okay? But I just did it to learn something about this option trading, okay? So at that time, GE stock was about $20, around $20. And one round lot is 100, okay? 100 units, 100 shares. Excuse me, let me turn this off, this heat. Sorry. Let me know if it's too cold. Okay? But this heat, when you stand up here, it really bothers my throat. Okay? When you do investment, stock investment, you usually do round lot. Okay? If you want to purchase any stock, the typical unit is 100 shares. Okay? If you want to buy only 20 shares or 50 shares, okay? It's called the odd lot. Okay? Okay? If you want to do an odd lot, then there may be some difficulty. It's really inconvenient because you may not be able to do it online, automatic trading, right? You may have to call up actual human broker and say, hey, I want to buy 50 shares of, whatever, right? And human brokers are usually more expensive than online trading, right? So usually it is traded on 100 unit, 100 share basis. Okay? So if 20 times 100 is $2,000, okay? And usually I did it 10 units of this 10 trades. So about $20,000. It requires, you have to have $20,000 in your account, in your margin account, okay? In order to write up or sell this option. Okay? So if I sell, I usually did that 3 months option, put option. Okay? Let's say today I do that. So let's say December, January, February, okay? February GE option, right? So February GE option at, say, $21, right? Suppose I sold 10 units of February 2016 $21 option, okay? Put option. Okay? What that means is this person, suppose you, Hyunwoo, okay, purchased this from me, right? Then you have a right to sell this 1,000 shares of GE stock at $21 until, well, $21 at the expiration day, right? Which is, what, third Friday of February next year. Yep. So if GE stock price is lower than $21, then you will definitely exercise it, right? So what that means is I'll have to buy 1,000 shares of $21 GE stock, 1,000 shares of GE stock from you, and I have to pay $21 per share to you, okay? That's guaranteed. Okay? At that time, if the GE stock price is above $21, what are you going to do? Are you going to exercise it?
I have to forecast future price of the GE.
No, I'm talking about it's, whatever, say, February 25th, let's say, right? That's the expiration day next year, right? 2016, right? At that time, on that day, GE stock price is $22. Of course, you're not going to exercise it, right? Because you can sell it, you can sell your shares at $22, right? If you exercise it, you get only $21 from me, right? So if that happens, then you will simply, what? Let them expire. Don't do anything, right? And it will expire, right? If it expires, when I sold this option to you, I charged a little fee, premium, okay? And usually at that time it was about 1.5%. So if it's $20, okay, $1.50. No, $3, 3%, 3%, okay? Premium of 3%. Sorry, 1.5%. So that's $3. Yeah, 1.5% is $3, right? Yeah? 3 cents. Okay. So I'm trying to remember it's a basically $20,000 investment. It's not really an investment because that money is still sitting on my account, right? But I'm putting $20,000 or $21,000 at risk, right? So if you exercise, then automatically my money, $21,000, will be transferred to your account, and your 2,000 shares of GE stock will come to my account. Okay? You understand how it happens when he exercises? I get his stock, and I pay $21 per share to him, right? So I'm putting $21,000 at risk. I'm not investing at that time. It's still on my account. I'm just putting at risk. Okay? For that, I get paid about $600, right? So that's about, is that 3%? I get 3%. That's 3%, right? Yeah. So premium is about 3% at that time. Well, it depends on what stock you write on. Okay? If it's a very risky stock, then of course the price will be higher, right? So in order to get this option from me, you have to pay $600 to me, right? Today, in November 2015, right? And if you let it expire, then that's it. That's the end of the trade. I keep $600. I already received it 3 months ago, right? And nothing happens, right? If GE price goes down to, say, $20 or $19, whatever, right? Or $20.99, even at 1 cent, okay? You will exercise, okay? And that means I have to pay $21 per share for 1,000 shares to you, okay? And your holding of 1,000 share will be transferred to my account, okay? So that's the worst case scenario, actually, okay? If he exercises, then I pay money, right? But I get the stock, right? GE stock. And GE stock is, pretty safe. Well, it may be a little bit lower at this time, right? Lower than $21, right? But, it's going to go up, right? So that trading is really it has really little risk, right? Writing the put option, right? So the regular investors, like Hyun-woo, right? They cover the bottom or downside, right? It's a trading term, covering the downside, right? Which means you're trying to prevent losing money, right? By purchasing put option, right? So regular trade with put option, you can cover regular trade with put option, right? So, you purchase GE stock. If it keeps going up, that's fine. But in case it goes down, right, then you can exercise your put option, right? So your bottom is guaranteed. Your $21 is guaranteed. GE stock may go down to $18, $17, but as long as you hold the put option, you don't have to worry about it because you can always sell your GE stock at $21, okay? If you do short sale, have you ever heard of short sale? That's another very popular trading technique, right? What is a short sale? Anybody? Short selling or short sale? That's right. You can sell the stock before you buy. Okay? That's a funny thing to do, right? You don't have GE stock, but if you think something's wrong with you, like Volkswagen, right? Yeah, a couple of weeks ago, maybe 3 weeks ago, right? Something really bad thing happened, and bad news spread, okay? And you think, Volkswagen stock's going to go down, right? Then you can immediately sell it. You don't have Volkswagen stock, right? But you can borrow it from the house at your trading brokerage firm, okay? And you can sell it, okay? Let's say what's the price now? Volkswagen price. That's let's say $15. Okay? So currently it's $15, but you're sure that it's going to go down, right? Then you can sell it at $15. Okay? And when, $30 right now? 130. Okay. It's 130 euros. So about what? What's the exchange rate these days? Let's say 100. Let's make it 100. Okay? When it goes down, you can buy it and return the stocks to the brokerage house. Okay? So you keep that difference. Let's say you did 1,000 share. Okay? So when you sold it, you received $100,000. Okay? And suppose it went down to 80. Okay? And so out of $100,000, you use $80,000 to purchase this share and return them to the brokerage house. Okay? and you keep that difference, $20,000 difference. Okay? That's the short sale. Okay? Sell first and buy it later. Right? Why is it called the short sale? Why does it have to be short time? This is an incredibly risky deal, okay? Because there is no bottom. If you start losing money on this trade, right? In the regular trade, there is a bottom. If you paid $20, if the stock price goes down to zero, it ends. You lost $20 per share, right? But here, you expected the price to go down. But instead, if the price starts going up, right? Every time the price goes up by $1, you lose $1,000 because you sold $1,000, 1,000 shares, right? So there is no bottom, right? If it starts going up and up, yeah, then it's a bottomless pit. Okay? It's a very risky deal. Okay? So you can't do this for a long time. If you think I made a mistake, right? If instead of going down it starts going up, then you have to cut the loss and get out of it immediately, right? Because you can't wait, right? Anyway, so if you're doing the short sale, then you can cover it with call option. Okay? And let's say, suppose you purchase $90 February option. Okay? So, in case, $110 February option. Okay? It's going to be pretty cheap. If something bad happens, and if you really think that this stock price is going to go down, right? What you're saying is in February, right? You have a right to purchase a Volkswagen stock at $110 each, right? So, in case in February, right, by February expiration date, Volkswagen stock price went up to $120 instead of going down. It went up to $120, right? Then you're going to lose $20 per share, right? Because you have to buy Volkswagen stock and you have to return that stock to the brokerage house, right? So instead of paying $120, you have a right to purchase it at $110. So you're saying, okay, I'm willing to lose $10 on this stock, $10 per share, right? If I made a mistake, right? But no more, right? That's the maximum risk I can take, right? So you can cover the short sale with the call option. You can cover the regular trade with the put option. Okay? That's the idea of using options to minimize your risk on trade. Okay. Okay. All right. So the question is, what's the value of an option? What's the appropriate premium? Appropriate premium you can charge or you can pay, right? What determines value of, let's say, call option, right? Well, you can understand a few facts here, okay? At expiration, if today is the expiration day, right? Then the price of option or value of a call option will be simply the difference between current stock price and exercise price. Okay? So let's say today, call option, using the same Volkswagen example, right? Today, the market price is $120, okay? But you are holding a call option with the strike price of $110, okay? Then how much is it worth to you, right? That's $10, right? Because instead of paying $120, you can pay $110 to purchase this particular stock, right? And today is expiration day. It's going to expire immediately, right? What about before the expiration date, prior to expiration, right? Then the value of call option tends to be a little bit higher than this difference. The difference $10. Okay? Why is it? Why is it a little, more valuable than $10? Let's say you have 1 month to go. Expiration is February, but today is January, right? And you're thinking about, so today, this is January right now, okay? January 2016, that's the current price is $120, right? You're thinking about purchasing the February option at strike price of $110, right? How much should I pay? So right now the difference is $10, okay? But what? But if someone is offering this option at $15, right? You can have this option, February $110 option, if you pay me $15. Would you buy it? You will consider. Why? Why would you consider? Right now the difference is only $10. Why would you pay $15 for that option? If you did, if you paid, right? And if you purchased that option, why would it be? Rise above $120, right? Starting from now, right? Yeah, so there is a chance that it may go up and even above $125, right? $620, $130, right? If you think that is a chance, that is a possibility, right? Then, of course, you will be willing to pay more than that current difference, right? So that's the idea. Usually, prior to expiration, right, the option price tends to be a little bit higher than the difference between the current stock price and the strike price, okay? Because there is a chance for appreciating stock price going up, right? Maximum value is stock price, of course, right? Because you're not going to pay more than stock price, because by having an option, you have a right to purchase this particular stock, right? So in no way, in no case, you will. Right now, the stock price is $120, right? That means you can purchase this stock at $120, right? There is no reason to buy option to buy this stock at $120, right? You understand? What if stock price goes up? Well, you're holding the stock, right? So there is no reason to purchase the option. Basically, purchasing an option is the same thing as purchasing the stock, but you are not paying the price right now. It's a deferred payment, right? Purchasing a call option is the same thing as purchasing the stock, right? At a very small fraction of the stock price, right? Instead of paying $20, right? You're paying only $3 right now. Okay? Minimum value is 0. Value of option cannot be negative. Why is it? Think about it. Okay? What's the worst case scenario? Huh? But that has nothing to do with the option. I mean, if you're holding the stock, then yes, that's a risk, right? If the company declares bankruptcy and the stock price goes 0, right? But that comes from holding the stock, not.
You just don't buy the stock at the exercise.
Oh, we're talking about call option here, right? Right? And the worst case, either you take advantage. Exercising means you are taking advantage of option. Option is a little bit value, right? Even 1 cent, right? You can get the benefit from holding the option. The worst case is you can let it expire if it's not worth to you, right? So it's 0, right? It cannot be negative, right? That's, well, sorry, I'm asking very obvious question, right? Right? Maybe I'm confused by that, right? All right. So because basically the value of option or call option comes from the difference between the stock price and exercise price. Okay? So the higher the exercise price, which means there is a narrower gap between the exercise price and the current stock price, right? The lower the call option value, all other things being equal. Okay? What are all other things? Okay? So in addition to that, the difference between the stock price and the option price or strike price, okay? There are a few other things that matter. Okay? So here's an example. Okay? Suppose you are holding a call option, or we both have call and put option here, right? Suppose the strike price was $80 for both call and put option, right? Think about the call option first. If current stock price is $60, how much is it worth to you? 0, because you're holding the option, call option, which is right to purchase at $80, right? So that option is completely useless because you can purchase the stock at $60, right? You're not going to exercise that option. That's a piece of trash, right? Right? $70 the same thing, $80 the same thing, right? If the current stock price is exactly the same as the strike price, well, you might as well just purchase the stock at $80 instead of exercising, right? But if the price goes up to $90, then since you have the right to purchase this particular stock at only $80, right, you can exercise it. That means you can save $10, right? Right? And so on, right? So the difference between the stock price and the strike price is the call value, right? But there is no negative. minimum is 0. Okay? Put value is the opposite, because put gives you right to sell this particular stock at the strike price, right? So if the current stock price is $60, but you're holding $80 put option, right? Then of course there is $20 benefit, right? By exercising it, right? You can receive $80 per share, right? Even though market price is $60 per share, and so on, right? So you have the opposite situation here. Okay? All right, so here's a chart, here's a graph that illustrates the concept. Oops, doesn't work that way. And okay. So look at this. On the horizontal axis, we have stock price starting from 5, 10, 15, and so on up to 40. Okay? And on the vertical axis, we have call option value. Okay? So if the stock price is below $25, apparently the strike price of this particular option is $25. Does it say? Here. At the bottom, it says exercise price is 25, right? So if the current stock price is below $25, then the value is 0, right? And starting from the strike price, as the stock price goes up, right, the value, call value, increases. And this, what should be this angle? What degree? Angle of this line, the slope. If stock price goes up from $25 to $30, then call value becomes what? $5, right? In other words, 1-to-1 match, right? For every $1 increase in stock price, call value increases by $1. So this should be a 45-degree line, 45-degree line, okay? Okay, you understand that, right? So that's the call value, right? That's the value of call option at expiration day, right? Before expiration date or prior to expiration date, okay, call value should be a little bit higher. This red dotted line, right? That's the value prior to expiration, okay? That's a little bit higher than this blue lines, okay? Again, the reason is there is a chance that stock price may increase, okay? So actually, if you have this call value line, okay, let's say one day before expiration, right? If it's one day before expiration, it's going to be almost the same as this blue line, okay? If it's 1 month before, 1 month before expiration, will be significantly higher, right? Why? Well, because you have more time for stock price to go up, right? So that's the difference, right? Yeah. This gap depends on number of days, okay? How many days you have until expiration. Maximum value. Well, maximum value is exactly the stock price, right? So this is the same 45-degree line starting from the origin here, right? So every time stock price increases, maximum value increases. That's about it, right? Okay. Here's another example for that remaining time issue. Okay? These are actual stock price of Apple Corporation, right? As of July 16, 2010, right? And we have a couple of options, or actually 3 different options: August option, October option, January option, right? And at that time, we have 2 different exercise prices. Right? So August 2010 Apple option at strike price of $240 was selling at $18.90, right? That's about 8%, right? No, is that 8% or? Yeah, I don't know. 7? No, yeah. Yeah, but a little bit higher than 7%, something like that, right? Anyway, okay, I guess Apple is a little riskier than GE, right? So the option price is a little bit higher, right? Anyway, so here we go. For the same exercise price, okay, the longer you have until maturity, until the exercise date, right? You have the price is higher, right? And the higher the exercise price for the same maturity, same expiration, right? The higher the exercise price, the lower the option price. Okay? Make sure you catch that. Okay? So we talked about 2 conditions, 2 factors. Okay? The difference between the stock price and exercise price that affects the option value. Also, time until expiration, right? That matters. Okay? The third factor is interest rate. It depends on interest rate. Okay? Why does interest rate affect the option price? Because, as I said, purchasing an option is the same thing as purchasing the stock at deferred payment. You're purchasing, basically, if you purchase the GE option today, call option today, right? Then basically you have GE stock because you can exercise this option, right? But you did not pay the full price. Instead of paying $20 full price, you paid only, $6 premium, okay? And when the time comes, or before the expiration, you can always convert. You can exercise it, right? You can pay the price. So there's another advantage of holding an option. Instead of purchasing the stock today, right? Why would you purchase an option? Well, because you want to minimize the risk. That's the most important reason. But another reason is you can delay the payment by purchasing the call option, right? Instead of paying the full price, right? Yeah. Well, is it really a good reason to purchase? What I just mentioned, right? I mean, primary reason, as I told you, is to minimize or eliminate the risk, right? But, because of the interest payment, right, it's advantageous to purchase the option? No. Why not?
You have to consider the opportunity.
Of what? Well, you are paying the premium. Of course, you save interest cost, right, by delaying the payment, right? But is that really greater than the option price? Probably not. Right now, the interest rate pretty low, right? So saving, you benefit from the purchasing option, right? From delaying the interest payment, right? That's not really a good reason to purchase option, right? But it matters. I mean, if you compare two situations, one with the high interest rate and low interest rate, right? Then if the interest rate is really high, right? Then, of course, there is a greater benefit, greater reason to purchase option rather than paying the full price of stock right now. Okay? Do you understand what I'm saying? Because you have to pay the premium, right? It's not really, saving from the interest, right? Cost, right? By delaying the payment, that's not going to really outweigh the cost of premium, right? But if you consider two different situations, high interest situation and a low interest situation, if the interest rate is high, then that's going to increase the value of option, right? Too cold? Is it blowing the cold air? It's off. I don't know. Okay. The last factor that affects this option value is volatility. Okay? Expected stock price volatility. Okay? Volatility means variability, right? What you think about the stock price range. Okay? If it's right now, let's say it's $20. Okay? If you think the stock price can go up to $22 or go down to $18, that can be one scenario, right? But on the other hand, let's say you think it can be $30 or $10, right? Or we have two different stocks, let's say A and B, right? And let's say this is G stock, which is pretty stable, right? And this is what, say, Genzyme. I think the company still exists. It's a biotech company which develops cancer treating drugs. Okay? And biotech industries are notoriously risky, okay? Because they may start thousands of projects. They invest in thousands of projects. Okay? And out of 1,000 projects, if they hit one, right? If they really develop the drug and pass all the tests and it's commercially approved, okay? Then it's it's worth, okay? Invest. They can recover the cost of all the thousands of trials, right? But that probability is very low, right? So if you look at the stock price of this biotech stocks, okay? It's like this, right? Every day it goes up $3, next day it goes down $3, and so on. Right? And this is actually a day trader's dream. Okay? It just goes, it doesn't increase or decrease, it just stays, right? And just goes up and down every day, right? So as soon as it goes down, you buy, right? And as soon as you purchase, as soon as you get the purchase confirmation, you put it on the market at $1 higher, right? And because it fluctuates so much, okay? Sometime in the afternoon you get the confirmation that it's sold at $1 higher, right? Well, if you're holding 1,000 shares, you just made $1,000, right? Okay? In a few hours, okay? And as soon as you got the confirmation, what? you do the short sale. Okay? And as soon as it comes down to $1, you buy and, end the trade. Okay? So, if you make $1,000 every day, that's pretty good, right? Anyway, so let's say this is a very stable stock. This is very risky stock, right? Has a lot of variability, right? Then the option price, option value on this stock will be much higher, right? Well, you think, why is that, right? There's a probability of appreciating, but there's also probability of depreciating, right? So why is it necessarily? The option value is higher. Okay. You have to understand here, payoff from, let's say, payoffs from up and down movements are asymmetric. Asymmetric. Because, if you are holding a call option, right, if the price goes up, then your option is useless. Okay? But, okay, because option value is, let's say, probability of going up, times share price minus exercise price. Okay. Plus probability of going down times 0. Okay. Maybe I confused you just now. Okay. So suppose you are holding a call option, right? If the price goes up above your exercise price, right, then it is valuable to you, right? Because you can save this difference. Stock price went up to $25, but you're holding exercise price of $20, right? So you get, say, $5 benefit here, right? And but if the price goes down below the exercise price, right, then it's not worth anything to you, right? So when this distance increases, right, the fluctuation increases, right, the option value just increases in one way, right? Even though there is also higher probability that it'll go down, right? If the stock is very risky and has a lot of fluctuation, right? Even though there's a very equally high downside risk, right? To the option holder, this doesn't matter. Downside doesn't matter, only upside matters. Okay? So basically, you're looking at one side. Okay? Forget about downside to the call option holder, right? So the one with the higher fluctuation has higher option value, right? Okay. You can think about, once we understand this concept, basic concepts of option, okay, we can think about some other situations, similar situations in the market. Okay? Call option on bonds. I'm sure you have learned about this, callable bonds. Okay? Some bonds, when they are issued, okay, the indenture is a contract, okay, that lists all the conditions about this bond. Okay. It specifies this bond is callable at some point in time, okay, and if this bond is called, then the holder of these bonds will receive a certain amount, okay, as the payment and so on. Okay. So what about this call option? Okay? Why a company would issue callable bond, and when it's an option. In other words, the company has the right to call this bond, right? But they don't have to. They are not obligated to call this bond, right? They can just let it expire, right? Okay? Let it pass. Right? All right. So why would when would the company call this bond? Well, the reason they would do that is to refinance the debt, right? So suppose they issue the bond at 7% annual rate, right? But market interest rate goes down, and actually you can issue new bonds at 2% currently. Then what they're going to do is they call the old bond, redeem. I guess before they do that, they have to issue the new bond. Okay? They issue the new bonds at 2% annual rate and use that money that they borrowed, okay, to redeem the old bond. Okay? So it's called the refinance, okay? Refinancing the bond. Okay? Or, so they can call it to do that. Okay? Another reason they would call the bond is to conversion, to let the bondholders convert their bonds into stocks. Okay? So that's actually our next topic, convertible securities. Okay? So some bonds, when they're issued, it says this bond is convertible. Okay? This similar idea, right? This bond, at some point in time, within certain period of time, okay, you can convert this bond into stocks, and it will say how many shares. Okay? Let's say each unit of this bond can be converted into 10 shares of stocks. Okay? Well, we'll discuss it later, why the company would do that, right? But that's another reason they would have call situation, right? So again, that's an option, right? They have the right to do that, but they don't have to do that, right? Common stockholders. If you're holding GE stock, GE is highly unlikely to do that, right? But any company, let's say Genzyme stock, right? Then you are the owner, right? Owner of the company, right? And let's say Genzyme issued bonds, right? In other words, they have borrowed money from some other investors. Okay? Then, basically, these stockholders who are the owners have an option either to pay or not pay the debt. Right? That's a funny thing to say, right? But that's a situation, right? So when they I mean, what happens if they decide not to pay? In other words, the owners, right? I mean, owners do not have direct control of the management, but they have ultimate control of replacing the the board members. I mean, the top management. Okay? So if stockholders really want, then they can force the decision not to pay the bond, right? Not to pay back the debt. If they do that, what happens? Well, let's say you issue the bond, right? And then that means every 6 months you have to make the interest payment, right? But let's say you decide, well, we're not going to honor this bond. So there's no reason to make the interest payment, right? So if you skip the interest payment, what happened? Huh? Well, before bankruptcy, this bond will be rated D on default. Okay? And yes, well, of course, that means you are not going to be able to borrow anymore, right? Or in short, you will do that in the worst situation, right? Maybe you're not really in the bankruptcy, but in the worst situation, right? But in the worst situation, in the worst case, you can decide not to pay the debt, right? So that's what we're talking about here, right? Stockholders have option to either pay or not pay the debt, right? That's a little bit funny thing to say, right? But that's so you can say that's the agency problem. Okay? In this agency problem, debt holders are principal, okay? And stockholders are agents, because debt holders lent their money to the company, right? And the stockholders and the managers, right? They're supposed to be agents to protect and work for the owner of the money, right? The people who lent their money, right? To take care of their interest. Okay? But we have two different goals here, right? Stockholders try to increase the profit. Okay? In order to increase the profit, you have to take on some risky projects. Okay? Bondholders, they don't share the profit, right? They only receive the interest payment, right? So basically, whether the company makes high profit or low profit doesn't matter to bondholders, right? As long as the company doesn't go into bankruptcy situation, right? And as long as they can make the interest payment, right? It doesn't make any difference to bondholders, right? So that's the the case of agency problem. Okay? All right, let's talk about convertible securities. Well, let's stop here today, and we're going to pick up from here on Tuesday. Okay? And we'll try to finish this chapter on Tuesday.